Welcome back. Time for the word on Wall Street. Top investors watching your money. Take a look at markets this morning under pressure. Dow Industrials down 183, NASDAQ down 81. Joining me right now is Michael Lee Strategy founder Michael Lee and Bulltech Capital Markets Chief Strategist Catherine Rooney-Vera. Great to see you both this morning. Catherine, let me kick things off with you. You also have this threat of a rail strike, which of course would slow things down considerably. Look, we'll see. I mean, in China, this could be the beginning of a miracle and to take down communism. But, you know, that would be a reach. But it could be. We'll see how these things develop. Or the tanks might roll in and the CCP might start a massive crackdown. So that's where we're going to focus on it. The macro economy, though, has already taken a hit here in the U.S., Mike. Take a look at housing. The S&P 500 Global releasing its Case-Shiller Home Price Index for September tomorrow. We'll get that home price index likely in step with what we've been seeing in housing, and that is a real demand destruction. What are you expecting, and what is your take on housing right now?
So housing really started to turn for the worse come April, May of this year. So as mortgage rates started to spike, the housing market really started to turn against us. And you look at, we had the home builders confidence index go from the mid-80s to the mid-30s. New home starts, home builder housing starts, new home sales, average home price, average time on the market, all these charts, all these data points are telling the exact same story. I mean, more often than not, when you're looking at an industry or sector, you get some sort of conflicting data. There is none of that in the housing market. What you hear from a lot of people is, yeah, well, you're just giving back a lot of profit. People have a lot more equity in their homes, and we don't have the leverage in the housing market the way we did in 2008. And I would absolutely agree with that. But what needs to be looked at is housing as a leading indicator for the overall economy due to the multiplier effect of building new homes. So as that slows down, as people are buying, are trading their homes in and out less, you're buying less tile, less furniture, less paint. You're not doing the same work on your homes as when the housing market is going in the opposite direction. And historically, when the housing market turns like this, 12 months on from there, you have a recession. And right now, with the drop in the NAHB index is telling us is that unemployment will be roughly double a year from now from where it is today, so between the 6.5% and 7% range. And keep in mind, the Fed was very late to the game here, and there's a 6 to 12 month lag to what the Federal Reserve does to the overall economy from their rate hikes. And just as recently as July, the Fed funds rate was at 2%, and now we're hovering above 4, looking like we're on our way to very close to 5. All that's going to hit in the middle of next year as the knock-on effects from housing and manufacturing. Now we're seeing it in earnings, and then finally we'll see it in unemployment. So all these things, this kind of perfect storm for economic slowdown is going to happen in 2023. And I think housing was our first indication that the economy is going to come to a screeching halt at the end of this year and into next year.
So does that mean you want to sell into any year-end rallies? I mean, we're about to begin the last month of the year. We've had a pretty good November for stocks. Do you want to sell into strength?
Yeah, I am. I have been. I think you want to be taking some profits off the table or selling some things that you wish you sold at the lows of this year. I definitely think there's a lot of motion in the ocean. I'd imagine stocks are probably 15 to 20% overvalued here, but stocks are inherently irrational, and there's no guarantee the market's going to go down with where the economy is going to go. Yeah. And the stock market will turn positive and start on the next bull market long before this economic situation is settled. However, if you're a cautious investor and you're looking for risk-adjusted returns, adding a little bit of cash to your portfolio, I always recommend you're never all the way in the market, you're never all the way out of the market. But if you want to reduce your stock holdings by 5 or 10 or 15% at this moment, probably not a bad idea.
Catherine, you agree with that? You want to sell into strength at year-end, given the economic macro story?